Good morning, everybody. I welcome you all to today's session on data analytics in investment management competing for your money. I'm Carolyn, your host, and I'm here to introduce to you our speaker, Sanjay Bhatia. Sanjay is a strategist, corporate developer, entrepreneur, and investor who has been in the oil and gas industry for over 25 years. He is the co-founder of Evolve Collective, a consulting firm that specializes in strategic and financial advisory for energy-related companies. He served as head of finance for Biota Technologies and led corporate development for FMC Technologies and spent over a decade in strategy consulting in leadership roles at Booz Allen Hamilton and Charles River Associates. Ladies and gentlemen, please welcome Sanjay Bhatia.
Thank you so much, Carolyn, and thank you for organizing this session. And thank you for everybody who's joining in this morning. Today, I want to talk about investment management, something that's been close and dear to me throughout my career. What I'd like to cover this morning is just define what is an investment fund. How big is this industry? You'll see this industry is quite sizable. And then how do we work? What is the investment fund that we've set up? And then I'm going to spend most of the time on why is the data so important. And hopefully you'll see that the data is quite important to making really good investment decisions and beating the competition. And there's so much data that I'd like to focus my discussion on that. And then what do I think is the ideal situation from a data standpoint? So first of all, it's an interesting time we live in. Of course, we say that all the time, but the equity markets are tough. Just to put into context, the U.S. market this year so far is down over 25%, and which is strange as we come out of COVID to think that the stock markets, both in the U.S. and around the world, would be falling so dramatically. But it is indeed a tough time. And why is this? When we were going through COVID, the government around the world, including the U.S., threw tons of money at COVID through jobs programs and business incentives, et cetera. Along with that, the Federal Reserve and the interest rate policymakers around the world lowered interest rates to near zero with so much liquidity. And then, as we all know, people sat at home. China has been grappling with COVID with their zero COVID policy. There's been underinvestment in energy. I mean, we've all been suffering as we go and fill up our cars with gasoline. Borders have been closed, meaning immigration has been very hampered. A massive housing migration, at least in the U.S., we saw people move into bigger houses out of the smaller city dwellings into larger suburban housing. And of course, we have this war that Putin has created this year. So all that's led to the situation we have now, which is shortages in labor, energy, food, housing, and things from China, as we found through tightening supply chains. And what's happening is we're seeing really high interest rates we haven't seen for at least 25 years, and a ramp down in liquidity and money supply. And we also still see governments like in the US spending a lot of money on infrastructure. So we have a lot of need for labor, a lot of government spending, but there just isn't enough of it. And so pricing is going up. And so this creates a situation where being really wise in investing is important. When the market goes up, everybody wins. When the market goes down, only a few people win. And the reason those that win is because they're able to take data and put it in a way that creates great insight and helps them edge out the market. And that's what I like to focus is on the importance of data. What is an investment fund? An investment fund is basically taking in multiple investors and applying a certain policy or principle to that investment to make decisions in terms of stocks, or it could be in bonds or real estate, et cetera. So an investment fund is just being able to collect investments from multiple people, and that collection from multiple people creates an efficiency in the investment. And there's different types of investment funds. There's mutual funds, money market funds, hedge funds. As you all know, there's just thousands and thousands of different funds out there. One category of funds is the hedge fund industry. And the hedge fund is basically a private managed fund that is very active and has a certain point of view and invests in certain types of assets. So it's different than just an ETF that invests in, say, the S&P or a large index. You're making individual decisions. And if you look at the hedge hedge fund sector, just from this pie chart, the hedge fund industry just in the US generates about $142 billion in fees every year. These are profits basically, and manage on the right side, you can see about $4.8 trillion of money. So it's a very large industry, and that's just the hedge fund. It doesn't include all the other mutual funds that you may see from Fidelity, et cetera. What are some trends in the investment management industry, including these hedge funds? There's a move away from tons of analysts. There used to be armies of analysts that would basically go about their day looking at different data, and it was very time consuming as well as obviously expensive with lots of large group of people. Moving towards more algorithms, and that's where the data analytic becomes very important. There's also more focus on specific types of data analytic, optimizing the trades. I'll discuss in a moment. You could make 5% on a trade, or you make 7%, and it's just based on being very smart about the data you collect and how you analyze it. And that 2% difference, even though it doesn't sound large, over time is very sizable. And then the last piece is that active portfolio management is very important. It's really important to be able to understand the risk inside a portfolio compared to the return. So if somebody says, I'm going to be able to generate 40% returns, that seems excellent. You have to ask, what's the risk? What happens if the market goes down? Does that cause a large decline in the returns? So it's important to understand that dynamic between the expected returns of the portfolio and the risk. So one of my passions is investing, and we've created a fund which is designed to generate high returns at a lower risk. And what we do is we aim to find the best values out there in terms of what are the best stocks out there to own, the best companies at the best valuation. And we try to generate cash flow with capital appreciation, and we manage the risk very thoroughly against market volatility and different scenarios. And we don't want to be focused on any particular industry, because too much exposure to one sector creates too much risk. So what we're trying to do, or what we do is combine fundamental technical analysis and option flows, which I'll describe in a moment, into our fund. And one of my favorite quotes is from Warren Buffett, is price is what you pay and value is what you get. So what our mission is to really find the best companies out there and get them at the best price. So we're trying to find the best deals out there. And to do that requires quite a bit of data. And what we do is we analyze over 1,800 US equities that we have in our database, and we do an analysis every week based on fundamental analysis, technicals, and option flows. And this database includes basically anything over $1 billion in market cap. And part of the strategy is we find the best values out there at the best price, and we sell puts on that to generate income. And so we're delving into the options market, which is a whole nother set of data that's required. And we because of this methodology, we find the best price, or we buy the best companies at the best price, and then we rigorously optimize the portfolio. So that's what we do. To put it a little bit graphically, on this chart, we have 1,800 equities, with each dot representing a particular stock in our screening portfolio and our screening methodology. We screen this, and we pick about 50 of the best of the 1,800 here, and we actually put a trade on that. And with these trades, we're generating some cash flow, and only the best of these 50 do we end up buying in our portfolio. So this is a lot of data that goes into this analysis, from the screening of the 1,800 stocks, which is just a ton of data there, to the options selection, to the portfolio selection and management. So there's lots of data that needs to come together. And unfortunately today, for the most part, it's a manual. And I think this presents an opportunity for companies like Chainsys to develop and help the investment sector develop more automated capabilities. And on this slide, I've broken the data sources into two categories. One is new investments. These are, how do we pick new stock to enter our portfolio? And on the right side is, how do we manage what we already have? So on the left side, here's all the different types of data that comes into our analysis. Earnings fundamentals, look backs. So it's important to look at, how did the company do in a recession, for example? How did the company do when the economy was doing well? So it's important to understand how this company held up in different cycles, looking back over the last 20 to 30 years. There's technical data, option flows, which I'll describe a little bit more, option pricing, portfolio optimization, benchmarking. This is all the analysis that goes into making a new investment. But once you have a portfolio, it's really important to understand the risk. What's the value at risk? Meaning, if the market goes down 20 or 30%, where's my portfolio sit? Am I going to be in trouble? Am I going to require to go on margin, and how much margin would I require? And should I even go on margin? So these are all important questions. What happens if the market drops 40% over the next few months? And how does my portfolio handle that? And then relatedly is, am I diversified? Am I too diversified? If I have 100 different companies in my portfolio, how am I any different than the broader S&P index, for example? So constantly looking at this portfolio and asking these questions, including how do I beat the S&P, or do I even have a good chance of doing that, is really critical. So each of these dot points, there's just a tremendous amount of data that's required analysis. And I think a lot more of this data flow can be automated. So one of the most important things, if I do a little bit deeper dive on some of the key pieces of data. One is earning fundamentals, which I call the mother of all analysis. This is really critical. And what earnings basically is, what is the company earning per share? And this is basically, how strong of a company is it, and how much should I pay for it? Those are the fundamental questions that are embedded in this analysis. And the earnings estimates change often. Just for example, this morning we had a new inflation report come out in the U.S. and it suggested inflation is still high. So that means interest rates are probably going to stay high for longer. So what does that mean for a particular company's earnings? So the analysts who cover the stock are now reevaluating all the earnings of the companies and will modify them accordingly over the next couple of weeks. That's the type of data that I need for my analysis. So it's really important to understand what are the earnings, where are they headed, how are they changing, and to be able to incorporate that into our analysis. One of the things I would love to have is the ability to integrate earnings and cash flow into a dynamic dashboard that tells me which earnings estimates have gone up, which ones have gone down, by how much, who's reported earnings, was it a good earnings report, did the earnings estimate change accordingly, and just being able to see that real time without having to go through that manually would be really important. And so this is really probably half of the analysis. And the way I think about this is you want to be able to find a great looking suit. Let's say if you're going shopping for a suit, and you want to be able to find it for 40% off, and you want to know when you pay 40% off for that suit on sale that it's a good suit. They're not trying to sell you something that's a lesser quality, and that suit's always going to look good for you. And that's the way I think about selecting stocks, is I'm trying to find the best companies to withstand any situation, and that the company's always going to be strong for the long term. And I want to pick up that company for 40% off. And if I'm able to do that, I'm going to succeed. And that's all based on earnings. So a couple examples of this is I have a company, Walgreens, on the left, and you can look at the earnings per share, which is EPS, over the years. And you could see the earnings last year was $5.04. This year it's going down a little bit, and then it comes back next year. And I show this in comparison to Intel, which in 2021 generated $5.50, but suddenly for this year it's falling to $2.23. So it's a much steeper decline than Walgreens. And so all else being equal, I like the Walgreens earnings stream much better than the Intel, just from an earnings standpoint. But this is the sort of analysis I just did manually. These numbers change regularly and need to be integrated with other pieces of analysis in a much more automated fashion. There's another set of data that's called technical analysis, and this is has nothing to do with earnings that I just covered. It has to do with how oversold or overbought is a stock. So for example, if a stock goes down for many, many days in a row and goes down significantly, it could be that all the sellers have finally gotten out, and you'll start to get some buyers come in that think they can make a few bucks very quickly by buying something that's really beaten up. So this is a bit of a indicator that suggests in the short term when's the best time to buy a stock. And the other piece of analysis I look at is options flows. And I just pulled a roster from a data service that I subscribe to that every day shows the major options activity. So for example, here's a company called Marathon, symbols MRO, and a large investor has purchased a sizable amount of call options, meaning that they believe the stock is going to go up in the next week or so, and they put a significant amount of money. So I watched this data flow come in, which is options activity, and if there's something unusually bullish that somebody is making a multi-million-dollar bet on, that captures my attention, and I incorporate it into my analysis. So just to give you a snapshot I have a manually created spreadsheet. It's populated automatically through several data sources, but it has 1,800 rows and about 500 columns with all sorts of data going back in time that I've highlighted for you. And this is very suboptimal. This needs to be more automated. The data needs to be cleaned, the analysis done, and dashboards created. And much of the investment sector, when I talk to others, are still living off of spreadsheets like this. And so there's a tremendous opportunity in a very sizable industry to optimize the way data flows and data analysis is done. So what's my dream in this regard is really a revolution in data cleaning, integration, and interpretation that combines all these different data flows. And hopefully I've made it clear that there's a tremendous amount of data that comes together of different forms from different sources that needs to be combined. I also dream of an AI that could actually rechart stock charts and find technical bottoms. That's largely a manual process today. And then one thing I didn't cover yet is the ability to pick options that are at the best timing, that are optimizing the premiums versus the risk. In all this, the data accuracy has to be high, and it has to be 99.5% accurate, if not higher. And right now, the accuracy of data is very suspect in at least the data I collect. And finally, I dream of a data flow and analysis that every decision made, every trade made is optimized, where we're able to get that extra dollar on each trade with less risk than the manual process that I have. And just to highlight, here's a chart for Walgreens that I talked about before. And actually to look at this chart and understand where might the bottom be, or where was the bottom over the last 2-3 years in this stock price, for example, which is important for my analysis. The best way I know how to do that now is manually. But if there's a way to use some AI to be able to interpret this chart and suggest where is the bottom, or where was the bottom in the last 2 years, and incorporate that into the analysis, that would be excellent. So let me end with that, but I would just like to say there's a tremendous opportunity for managing large amounts of data in this sector, and I'm struggling with it real time today. So thank you very much.
Thank you, Sachin. So let's move on to the Q&A session. We just have about 8 minutes in hand. So those of you who want to shoot in your questions, there is a Q&A box below. Kindly bring in your questions there. Sachin, I have a question for you. What
Yes.
are the data sources?
So there's many data sources. Some of the data sources for the stock price comes from simply from Yahoo Finance, as an example. The earnings database, earnings comes from a database that I use that has the latest earnings estimate. The options flows comes from yet another subscription that I have. So there's multiple data sources. Some are public, some are subscription based. So there's probably about 10 to 12 different data sources.
Another question. What is the advantage of algorithmic trade identification?
Yeah, so the advantage of that is when it's done manually, I believe we're leaving money on the table. So to give you a couple examples, when we select an actual option to buy or to make a trade on, it's not optimized. It's basically a manual process to select the right option and look at the price manually and make a bit of a judgment call on the premiums versus the risk. So that's all done through a manual process. Now, if there was an algorithm that could actually take in all that data and analyze the premiums versus the risk and be able to put out the best option out there, the best instrument to use, that would be advantageous. I think that would yield a much higher percentage return on the investment, as well as offer a lower risk. So that's one of the advantages of algorithms. The other one with this chart that I have here, to look at this manually to be able to interpret it in a timely fashion is very difficult and correctly. But if you put all this data into an AI and you asked it to basically say, what is the low point in this stock, or where might it go based on historical patterns, that would be a very powerful piece of information to have and analytics to have versus doing it manually. It'd be much more accurate, and you could do many more of this type of analysis than you could manually.
Okay. How many people are analyzing this data today? and how much time they spend on a daily basis?
I have about two people that work on this, and we don't even cover the waterfront, so to speak. It's not enough people or enough time to do everything I like to do, but we have two people full time. The larger funds would have 10 to 15 people doing this, so it's a very labor intensive, analyst intensive type process. So obviously, by having a more automated process, a way to pull this data, clean it, organize it, I think would cut down on the number of people required. And then those people can actually spend their time, less time managing and organizing the data, and actually looking at the results of an algorithm in a much more intelligent way.
Okay. For charts to know the bottom, current statistical math, would you be able to find? Is it not so?
I'm sorry, Caroline, could you repeat that question?
Sure. For charts to know the bottom, current statistical maths would be able to find. Is it not so?
Yeah, so there's no way to 100% say what's a bottom and when that bottom might happen, but doing the analysis provides at least some historical information to potentially predict the future. So as an example, by looking at this chart here, and if you go back further in time, this is a chart that goes back 1 year. But if you had a chart that goes back 2 or 3 years, or even 20 years, and you say, well, what was the pricing pattern of Walgreens as we went into a recession? And how low did it go during that recession? Or how high did Walgreens go in a better time? Then that helps you predict the future potential price ranges going forward. But it's impossible to predict with precision. If there was a bottom 2 years ago and it was at $30, that with certainty it's going to be $30 in the future. That's unknowable. It's unknowable to be. It's hard to be that precise, but at least it gives you some confidence and some ability to predict the range it could be in. What range it could be in, given the different economic scenarios we may be looking at in the future.
Another question. Do your data sources have readily available APIs, or are you considering a screen scraping solution to make it available to your algorithm?
Yeah, I think that's a great question. So most of the data sources have APIs, from my understanding. So if I go back to these data sources here, most of these do have APIs that could flow in. I think the one that doesn't, as your question alludes to, is probably the charting type. But I think that could also be recreated through APIs if you're able to link in historical pricing and other data. So I think those charts can also be developed through API links. So I would say probably 90% plus is through API links, or potentially through API links.
Great. One last question we can take. How can Changes help in this process?
So I think Changes is well positioned to help bring in the data from these different sources, structure it in a way. Well, I would say first, make sure it's clean and go through data integrity process, and then structure it in such a way that the data is always clean, available, and then also put a couple of algorithms on top of that data. So I would say probably 75% of the challenge is handling the amount of data and making sure it's clean and structured. And about 25% is doing the analysis on top, which I'm sure Changes as well has the capabilities of doing, the AI type applications on top of the data.
All right. Thank you so much, Sanjay. Thank you so much for
Thank
taking
you.
time off and being here, making our conference worth the while. I thank each and every one of you for joining the session, and you all have a great rest of the day. Hoping to see you
Thank
in the
you.
next. Yeah. Thank you. Bye-bye.